Alright guys, welcome to the Ichimoku system intermediate video. Before you start trading, you kind of have to figure out what kind of trader you want to be. You want to be more of a day trader or a swing trader. If you're looking at a chart and you're looking into the daily or 4-hour chart or a 1-hour chart, those are more like swing traders. Those are people that want to be in the stock for about a month or so for it to really start giving you what you're looking for. If you're more of a day trader, it's more like 30-minute chart, 5-minute chart, 1-minute charts. Those are the ones you're in and out of the market faster. And so once you understand where your trading preferences are, you don't want to get too far away from that, going too high. Let's say you're on a 30-minute chart and you're looking at a daily or a weekly chart. It's going to mess you up. It's because one signal is going to be high, go up, get in there, and the other one says, no, we're going down, don't get in. And you're going to be like, well, what am I looking at here? You got to stay within the area of what you are trading. And I'll explain that in a few minutes. So when you're looking at the system, and we're over here on the daily, the Ichimoku works better on higher time frames. It's a lot smoother. As you can see, the lines cross, you know where the TK cross is, you see the chicken sen, you see everything nice and smooth doing its thing. It goes up, it goes down, get clean. And as you can see, like if you would have gone long over here, you're looking at May 18, by the time it does its run, it takes time. You can see it, where it moves, it takes like a month or two, before it actually does its full range. Same thing if you're going short, you get in here around 2018 here, or 1019, excuse me, and you're working your way down. It takes a couple months for it to finish a cycle. So once you start going down to a 4-hour, 30 minutes, the time frame gets shorter and shorter. For me personally, I don't like trading this high because I have to wait too long for the stock, and it's kind of like waiting, watching paint dry. And it drives me nuts. I like to get in and get out. It's my preference. Everybody's a little bit different. So with me, the 30 minutes is where I like using mine because I'm kind of in and out within a day, maybe 2 days. I'm in a stock and I'm done, and I move on to something else. Also, notice the signals that the lower time frames I get, it gets more choppier. This is why with the Ichimoku system, the 30 minutes is where I stop. Anything lower than that, I use different signals because I have other signals that are like cleaner for the shorter time frames. Here we are down to a 1 minute, and see how it gets all choppier? It's because it's just too much. Yeah, it's too much to process. So it's kind of hard to get an average of the last 9 candles when the thing is look like something just went comatose on you. So 30 minutes is where I go. Doesn't mean you cannot use it. If you find that it works for you in a lower time frame, go for it. For me, it gets too confusing. So when you look at a chart and you're about to trade, you need to understand that not all stocks work in all time frames. So you might find a stock that works better on a 30 minutes, but you might find it cleaner on a 5 minutes, so you work out of the 5 minutes. Or you might find out that it works better on the 1 hour, so you work out of the 1 hour, because not all stocks work clean every single way, every single time. You just need to see the pattern and look at the history of the stock. Not all stocks work well with the signals you have set up. So if I'm looking for specific signals that I like using to get into the stock, not all stocks are like that. Sometimes stocks the signals are all over the place. I don't trade those if I see that that's not giving me what I want, so I just move on to another stock. You just have to know that certain things don't always work with every single thing. Get familiar with the stock. Look at the pattern. And you'll see that a lot of them do the same thing over and over and over. If you can catch those patterns, then you'll know where the stock wants to go. Okay? All right. So we're going to work on the first one. What is it that we're looking through when you're using the Ichimoku system? One is called like a squeeze. And I don't mean the squeeze where you see the TTM squeeze on the bottom. It's a different kind of squeezes where you got for the tenkan sen and the chicken sen, and your candles are like banging into the two, and they're bouncing back and forth, back and forth, back and forth. It's kind of like the market's not going anywhere. So what I like to do, if the market is practically ranging, nothing you can do about that, you just go back and you mark it. You're like, okay, here's the highest high back there. Mark that one. and then it went down here because this wouldn't have happened yet, and you mark it right over here, and you mark that, and you kind of like wait for it and see if it gets through this range. You want it to get out of it. Now some people want to say, well, why aren't you using this one down here? Well, you could. I mean, you just have to kind of look at the history. This is where you have to look back. If you go back here, it used it before. It bounced off of it. Okay, and then used it here, so it kind of keeps using that area. Other people will be like, well, no, it should be this one down here. Well, all right, well, if that makes you happy, use it, you know, because it hit there once. That's it. There's nothing else that hits it. The future kind of breaks through it too. So if it makes you happy to do that one, hey, go for it. Whatever helps you trade. There, I will do there. Now everybody's happy. See, now we got two. All right, so that's because it's an area. It's not really specific, 100% always on the nose. It's an area of where the stock may bounce off of or be rejected off of it. All right, so I wait for it to break out of these things. If you know, and if you're above the cloud and it breaks above it, that's going to be a nice little run because it's strength to the upside. If it breaks below, then it's going to be bouncing off of these things, but maybe rejected off of them and going back up. So this is how I look at those. Another thing I look at is overbought and oversold. This system works really, really good. It works just like the RSI, the stochastics, the MACDs. It will tell you if something gets overbought or oversold. And the way to do that is your tenkan-sen and your chicken-sen, they love dancing around each other. They're partners. They work together. They will never get away from each other for too long. They always stick together. And if the tenkan-sen gets away from it, it will eventually come right back to it. So you need to, depending on the strategy that you're going for, you have to find out, is it going to come right back to it, or is the kijun-sen going to catch up to it? So either way, it's going to happen. And here are the two ways. When, let's say we use this falling one here, as the candles are falling, you see that tenkan-sen's getting away from the chicken-sen. Chicken-sen's already flattening out, saying, okay, this is about as far we're going with this. As you're falling, the candles are getting away from the tenkan-sen too. So that is an oversold signal letting you know that everything is too far and the market is out of balance. It's going to want to come back to it. So this would be a great opportunity to jump in and let it ride back up. I usually let it ride back to one of these. You'll see the pattern to them. So if you bought in around 170 and it snapped right back to 180, that's a 10-cent run. In this particular case, it kept running. Okay, so this is how you know if it's overbought, oversold. Same thing up here. Let me clean these things out of here. So let's say your candles are going up, candles going up, candles going up, but the tenkan-sen is way down here. Okay, so it's the kind of letting you know that it's overbought and it's going to come right back to it, and it does. And then these guys are back together again, like they like being their partners. So there's your overbought and oversold signals. Okay. Also, you got the momentum. It likes to slow down. This is where the chicken-sen comes in. It's very handy of letting you know when a signal's slowing down. It's easier if I do it on a daily. It's a lot smoother. So let's say, for example, let me see if I can find one. The market is falling. Yeah, we'll use this one. That'll work. Let me zoom in a little bit better. All right. As you see that the market starts to fall, the lines drops and then straightens out, then drops, then straightens out, then drops, but it's kind of taking more time. Drops, falls, relaxes, fall, relaxes. It's kind of like letting you know that the breaks in between are not as big as before. I'll just do this. They'll probably be faster. See, the market is slowing down. It's letting you know that it's taking more time or less time to just be in that same area. It's not going as far as before. It's giving you a signal of that the market is slowing down in that direction. Plus, once the candles got way down here and it got away from it, you know it's going to be turning around. So it's kind of like a momentum indicator. And if the market decides to stay in a range, and the dark blue one is way up here, either this stock is going to come back to it, or the kitchen center is going to start working its way down to meet up with it. And once it meets up with it, then it'll continue to run. Because it's always one waits for the other. So that's where you start figuring out which direction is the market going to go. So, all right, let's see, 521. I think I can see this one. Yeah, here's a good thing. No, like it went up, it got too far away, it came back. Then it's starting to play its game which way. And then notice how this guy's going up. If it goes up, that's a good signal for you that the market's continuing to go to the upside. Okay. So now you're saying, well, how do I know when to get out? All right, well, let's say you're in a stock, you got the TK cross, looks good. Your future looks bright, it's green. You look back, it's above the cloud, there's nothing in its way. So you decide to buy in. You buy in around 357, let's just say when it closes. And the market's riding. And then you'll be like, okay, well, when should I get out of this stock? For me, I stay in it until you get a TK cross to the downside. But sometimes that can take you out, you can lose $1 or so out of that, but for waiting so long. So what I like to do is start marking where there's resistance were. Oops, I'm using the wrong one here. Let's try this one, it's easier. So the market broke to the upside, and there was a pause there, and it came down, but it didn't break that. So it kept going up, it's working its way up. And as it moves up, I see that it made another line here. So I'm like, okay, so then I'll move this up. So long as it doesn't break that line, I'm good. It continues to move, and now it made another signal. All right, so I'll keep moving this up until it decides to break it. Once I see that it breaks it, let's say you get up to about right here, give or take. It decides to break that below that, then I'm out. In this particular case, this one would end up being pretty good that the kitchen sink kept it pretty tight for you. But sometimes the kitchen sink could be way down here, and there's just too much of a span for you to be losing all that money. You have too much money on the table. So I kind of bring him up to once it breaks that, I'm out. That's it. I made my money. So if I got in around here, around 368, and it worked its way up to 546, that's not bad. You got your money's worth out of this. Okay. Now, you can be technically 50% of the time wrong in picking a stock. So you went in 10 times, out of 10 times, you made money 5 times, and the other 5 times you were dead wrong. As long as you keep your losses tight, you can still make money. Because everything you do is a 3-to-1 ratio. For every $3 you can make, you're willing to lose $1. Once you know your resistance lines and you know where you want to hit and you want to get out, here, grab a pen and paper. You did 5 trades. They weren't good. Let's say you got $300 for each of those trades. But the other 5 trades, you went wrong. So you lost $100 for each of those trades. So 5 times 300 is $1,500. Now the 5 trades that you did wrong for $100, that's $500. So you won $1,500 on the good trades and you lost $500 on a bad trade. You still made $1,000. That is if you are 50-50. You can flip a coin and get 50-50. So the market is designed for always to steal your money. The key is for you to keep your losses tight, not stay in there and be like, well, it might turn around, because now your $100 loss turned into $500 loss, turned into $700 loss, and you're like, no, the market will turn around. No, it won't. You're already way past your point. Even if it does turn around, why take that kind of a risk? It's not worth it. There's so many other stocks you can try out. So if you keep your losses tight, and you know where your support and resistance lines are, and you know when to get out of those, you're still going to be profitable. That's why the 50-50 chance. A blind monkey can do that. Okay? So this is how you work on those. Now I'm going to show you something else on CHK 30 minutes. Go back to Friday. Somewhere in here. All right, check this out. So here's a stock that's falling, okay? And now you're saying, well, why are these signals down here? Because this is how I use what I use for my divergence. The market is falling, and I got myself a divergence going on right down here on the 30-minute chart. Oops, why can't I draw? I guess I can't draw on that one right now. All right, we'll skip that for right now. All right, so you got your divergence. You got divergence right there, and the market is letting me know that you did a fall, but it's going back up, and then you get your little break, and there it runs. So this is where my divergence lines run. Again, I don't go any farther than 30 minutes down with the divergence, because if you do it on a daily, you get $2, $3, $4 out of them. You do it on a 30 minutes, you might get 10 cents to $1 out of them, because it's a smaller time frame. So you also have to remember what time frame you're working out of, and not get too far away from it, because it gets confusing. All right, guys. So hopefully this will help you guys out. Keep making some money, and I'll see you on the trading room.